how to buy real estate with life insurance? Let me show you. So here's the concept. So as we've been going through on this channel, what we do is we use the asset called life insurance, specifically cash value producing life insurance. So what do we do with it? We use the cash value that the policy produces to purchase assets. And in this case, the asset is real estate. So, but you can purchase a car, purchase EFT, purchase whatever asset that you want to purchase. You can purchase it using life insurance. So, what you do is you pre-plan in a couple years or a couple months, depending on how much money you have. What you do is you fund the policy with as much money as you want to without triggering a MEF, which is a modified endowment contract. So, by funding the policy, what you do is you create a way for you to get assets without having to do any credit checks. Now, if you're someone who, let's say, is getting governmental help, or let's say you may not have the best corporate structure or whatever it might be, you're someone who might want to look at something like this because you don't want to mess up any of your benefits that you may be getting on the other end. Okay, so what this is doing is it's giving you access to funds without a credit check. Okay. Now all it takes is just a little bit of pre-planning. You don't just hop into it and then tomorrow you have 3 million, 5 million, or $10 million. You could, depending on how much you're starting with. But for most regular people who are starting out who can just put like 500, 600, maybe $1,000 in deposit per month, it takes maybe a 2 years, 3 years, 4 year, 5 year plan, depending on the type of asset you eventually want to purchase. Okay. So what you eventually do is you take out what's called a policy loan against your death benefit. Okay. Now the reason why you do that is because you want the money to grow. We make money as we're going, we make money while we're there, and we make money while we're leaving. Okay. So you want to take out a policy loan, not a withdrawal. That means your money, you can do what you want. But you take out a policy loan because what you do is you want to take the money out, purchase the asset, real estate. The asset is giving you money. You get that asset, you put it back into the policy, and what that's continuously doing is it's continuing the compounding interest. So as we know, the cash value producing life insurance, what it's giving you is 8 to 15% accredited interest to your cash value that's in your account. So what you're doing is you're using the life insurance policy literally as a bank. So you're going in using life insurance policy to purchase assets. The revenue that the asset produces, you fund it back into the policy. And the reason why you fund it back in the policy is because you want to take advantage of the accreditation in interest, 8 to 15%. So from the accreditation interest that you get, you keep recycling the policy, you keep recycling, purchasing more assets, purchasing more vehicles, purchasing more homes. The reason why you do that is because it grows the policy. And the more the policy grows, is the more your money grows too. Okay, and the reason why you do this is because no credit checks. It gives you the opportunity to have a death benefit if you like. If that's the only thing you like. It gives you the opportunity to have that, but it also gives you the money to have tax-free. Now, tax advantage strategies is why people use it specifically. Now, you can supercharge this by putting all this in a trust. And the reason why you put it in a trust, again, we speak about this all the time here on this channel, is because you want to eliminate or at least mitigate taxes and inflation. They are the number one silent killers of your wealth. And so with this strategy, with this life insurance strategy, 8 to 15% being accredited to your money, you are eliminating inflation, which is 2.5%, and you're also eliminating taxes, which in some cases, depending on how much money you're making, range from 20 to 60%. So 20 to 60% being given back to you can do a lot for you if you know how to plan properly. Okay. So 20 to 60% being saved on taxes, 2.5% of inflation, so your money's being saved. And so you're funneling all the assets through the life insurance policy, which is continually compounding upon itself, growing 8 to 15% continually year by year, year by year. So all the revenue that the assets are coming back and giving to you, you dump it into the trust, which owns the life insurance policy, which is a continual funneling upon itself, which continues to grow your money. Again, you make money while you're going, you make money while you're there, and you make money while you're leaving. Take care.